Welcome to our video on completing the accounting cycle. Today, we'll take you through the final steps necessary to prepare accurate financial statements and ensure the smooth transition from one accounting period to the next. This video will cover everything from the purpose of closing entries to a comprehensive example of the entire accounting cycle. Let's dive in. 1. Introduction to the closing entries. At the end of each fiscal year, companies must close their books to prepare annual financial statements and tax returns. Many companies also prepare monthly financial statements to get a clear picture of their performance during the year and provide timely information for decision-making. Closing entries are essential to ready a company for the next accounting period by clearing any outstanding balances in specific accounts that should not carry over. This process, known as closing or clearing the balances, ensures that these accounts start with a zero balance in the new period. This step is crucial for comparing performance across periods, especially for income-related accounts such as revenues and expenses. Why is this important? Imagine trying to understand a company's profitability over time if revenues and expenses were just cumulative without resetting. It would be nearly impossible to discern whether a business improved or declined in any given period. Closing entries help maintain clarity and accuracy in financial reporting. 2. Preparing the post-closing trial balance. The ninth and typically final step of the accounting cycle is preparing a post-closing trial balance. This trial balance is created after the closing entries are complete. It serves two primary functions: verifying that the debit and credit totals are equal, ensuring that only permanent accounts have balances. Permanent accounts, also known as real accounts, include assets, liabilities, and equity accounts. These accounts carry their ending balances into the next period. On the other hand, temporary accounts, which include revenue, expense, and dividend accounts, should have zero balances after closing entries are made. To prepare the post-closing trial balance, transfer the balances from the post-closing T accounts to the appropriate columns on the trial balance. Once all accounts are recorded, total each column and verify that they are equal. This step confirms that the ledger is in balance and that the accounts are ready for the new period. It's an essential step to ensure the integrity of the financial records and the accuracy of financial reporting. 3. Computing current ratio and working capital. The results from the adjusted trial balance are vital for calculating key financial metrics, such as the current ratio and working capital. These measures are essential for assessing a company's liquidity. Working capital is calculated as current assets minus current liabilities. It represents the short-term financial health and operational efficiency of a company. Positive working capital indicates that the company can cover its short-term obligations and invest in its operations. For example, if Supreme Cleaners has current assets of $50,000 and current liabilities of $20,000, the working capital would be $30,000. This positive working capital shows that Supreme Cleaners is in a good position to manage its short-term liabilities and continue its operations smoothly. Current ratio is the ratio of current assets to current liabilities. It indicates the company's ability to pay off its short-term obligations with its short-term assets. The formula for the current ratio is current assets / current liabilities. A current ratio of 2, 1 is generally considered healthy, indicating that the company has twice as many current assets as it does current liabilities. For instance, if Supreme Cleaners has current assets of $50,000 and current liabilities of $25,000, its current ratio would be 2, 1. This ratio signifies a strong liquidity position, suggesting that the company can easily meet its short-term obligations. These calculations help stakeholders understand the liquidity position of the company and make informed financial decisions. Investors, creditors, and management use these metrics to assess the company's ability to cover its short-term debts and obligations. 4. Comprehensive accounting cycle for a business. Let's walk through a comprehensive example of the accounting cycle for a business. Step 1. Analyzing transactions. Mark Summers, the owner of Supreme Cleaners, starts by recording all financial transactions, including purchasing equipment, paying employees, and providing services. Each transaction is analyzed and recorded to ensure accurate financial reporting. For instance, when Supreme Cleaners purchases a new washing machine for $2,000, Mark records the transaction in the journal, ensuring that the equipment account increases by $2,000 and the cash account decreases by the same amount. Step 2. Journalizing transactions. Next, Mark journalizes these transactions by entering them into the general journal. Each entry includes a date, account titles, and amounts debited and credited. This step involves detailing each financial transaction. For example, when Mark pays $500 for supplies, he records a debit to the supplies expense account and a credit to cash. Step 3. Posting to the ledger. After journalizing, the entries are posted to the general ledger, where each account's transactions are summarized. This step helps in organizing and categorizing all financial data. For example, all transactions affecting the cash account are posted to the cash ledger account, providing a detailed record of cash inflows and outflows. Step 4. Preparing a trial balance. Mark then prepares an unadjusted trial balance to verify that the total debits equal total credits. This step is crucial for detecting any discrepancies in the accounts. If the totals do not match, Mark knows there's an error that needs to be corrected before proceeding further. Step 5. Making adjusting entries. Adjusting entries are made to account for accrued expenses, unearned revenue, depreciation, and other adjustments that ensure the financial statements reflect the true financial position of the company. For instance, if Supreme Cleaners incurred $1,000 in wages that have not yet been paid by the end of the period, an adjusting entry is made to recognize this expense and liability. Step 6. Preparing an adjusted trial balance. An adjusted trial balance is prepared to confirm that the ledger accounts are in balance after the adjustments. This trial balance is the basis for preparing the financial statements. For example, after recording the adjusting entries, Mark ensures that the total debits and credits in the adjusted trial balance match. Step 7. Preparing financial statements. The adjusted trial balance is used to prepare the income statement, statement of retained earnings, and balance sheet. These financial statements provide a comprehensive view of the company's financial performance and position. Income statement summarizes revenues and expenses to show the company's profit or loss over a specific period. For instance, if Supreme Cleaners had revenues of $100,000 and expenses of $70,000, the income statement would show a net income of $30,000. Statement of retained earnings shows changes in retained earnings over the accounting period, including net income and dividends paid. If Supreme Cleaners paid out $10,000 in dividends from its $30,000 net income, the statement would reflect retained earnings of $20,000 for the period. Balance sheet provides a snapshot of the company's assets, liabilities, and equity at a specific point in time. For example, the balance sheet would show Supreme Cleaners assets such as cash, equipment, and supplies, liabilities such as accounts payable, and equity including retained earnings. Step 8. Making closing entries. Mark makes closing entries to close out temporary accounts such as revenues, expenses, and dividends. These entries transfer the balances to the retained earnings account, preparing the accounts for the next period. For example, the revenue and expense accounts are closed to the income summary account, which is then closed to retained earnings. Any dividends paid are closed directly to retained earnings. Step 9. Preparing the post-closing trial balance. Finally, a post-closing trial balance is prepared to ensure that only permanent accounts have balances and that the ledger is in balance for the new accounting period. This step involves listing all permanent accounts and their balances after closing entries are made. If the total debits and credits are equal, it confirms that the accounts are correctly balanced and ready for the new period. Completing the accounting cycle involves a series of meticulous steps that ensure accurate financial reporting and smooth transition between accounting periods. By following these steps, businesses can maintain reliable financial records, provide valuable information to stakeholders, and make informed financial decisions. Closing entries help reset temporary accounts. The post-closing trial balance verifies ledger accuracy, and key metrics like working capital and current ratio offer insights into financial health. Each step, from analyzing transactions to preparing the post-closing trial balance, plays a critical role in maintaining the integrity of financial records. Thank you for watching our video on completing the accounting cycle. We hope you found this guide informative and helpful. Stay tuned for more videos on financial accounting and best practices for maintaining your business's financial health. By mastering these steps, you'll be well equipped to ensure your company's financial records are accurate, transparent, and useful for decision-making.